see here. All right, everybody. Welcome to the June Elevate event. I'm Adam Koos, business transition consultant and founder of Elevate. I'm also the president, portfolio manager, and senior financial advisor at Libertas Wealth Management Group here in Columbus, Ohio. And I'm hosting alongside financial advisor, certified retirement plan counselor, and certified financial planner, Kim Warwick. Let's just get started really briefly with a couple housekeeping items as always. Elevate started with 3 statistics in mind. The first is that 80% of business owners' net worth is tied up in their business. And this probably sounds familiar to a lot of you who are watching or listening. And, when it comes to your own businesses and your own net worth. The other statistic is also 80%, but this time it's 80% of businesses never sell. They dissolve in the end. They leave the owner or owners with nothing to show for their life's work, which is just really, really sad. And it's one of the 2 biggest reasons why we've started Elevate a few years ago. And then lastly, of the 20% of companies that do sell, 75% of those 20% exit their businesses for less than fair market value. And there's a number of reasons for that. Now, today, we're not going to talk a whole lot about that. If you'd like to learn more about exit planning, business transition planning, and things of that nature, head to elevateandexit.com. You can head to our YouTube page. You can look at Spotify, Apple Podcasts. We've done tons and tons of material about exit planning and business transition planning specifically. But one of the pieces that we discuss as part of the holistic approach to growing a business is real estate. And that's what we're going to be talking about today is most owners, I shouldn't say most, but many owners own real estate as part of their business, whether that be the office that they work in, whether it be the properties that they rent out, whether they're doing flips, things of that nature. So when I say Elevate started with these 3 statistics, it's crucial to understand that our mission, that all the education we share today and on every other podcast, screencast, webinar, as well as the consultation we offer through our professional partners, Greg Smith being one of them, who's going to be our feature guest today. I always say that we need to get the phrase exit planning out of our vocabulary because it doesn't matter if you're planning on selling your company in 3 years or 13 years. Business transition planning is something that every growing and or mature business needs to get unstuck. Take their company from good to great, as Jim Collins says, and whether you're selling soon or not, to treat your business and plan to create a sellable enterprise today, even if you're not selling today. So for more information on business transition consulting, exit planning, retirement planning, executive benefit plans, and investment management for business owners, head over to elevateandexit.com. Be sure to not miss out on any of our future events by subscribing to our YouTube page, where all of these webinar replays reside, as well as our podcast. You can find those there as well. You can also head over to the website again, elevateandexit.com, to sign up for our exclusive educational podcast articles, the live events that we hold, and as well as everything else we do, which is it's all aimed at directly growing your business, increasing profits, increasing efficiency, reducing the amount of time required of the owner within the business, de-risking, all the while growing your enterprise value for your company along with your net worth so that you can make work optional someday and lead a stress-free lifestyle. One piece of housekeeping: all guests and attendees will remain intentionally confidential throughout this entire presentation, as well as throughout the entire Q&A session that follows at the end. So as you're listening and or watching, please enter any questions you have into the chat or Q&A, and Kim and I will be sure to compile them anonymously at the end, after which all questions will be answered at the conclusion of the presentation. So if for any reason, by the way, we happen to run out of time, all questions will be answered and delivered directly to your inboxes using the email you entered when you RSVP'd. All right, enough of the housekeeping. Today, I am thrilled to introduce our feature speaker, Greg Smith, the Ohio, Kentucky, Kansas, and Missouri Vice President for Property Exchange Services, Inc. He was admitted to the Ohio Bar back in 1996 and also admitted to the U.S. District Court for the Southern District of Ohio. He received his BA from Kenyon College, and he is a Juris Doctor from the Ohio State University College of Law. He originally practiced real estate law with a firm in downtown Columbus, and then was also with Chicago Title before joining IPX. And with more than 22 years of experience in the field, Greg is a seasoned professional who's facilitated countless, and I was going to ask you how many, Greg, but if you even know, but countless successful 1031 exchanges of real estate. He's also a frequent lecturer on the topic. He does several of these presentations throughout the year. And this is actually the second event we've done together, Greg and I, with the last one being a live event we actually did in Columbus, Ohio for residential and commercial real estate investors back in 2022, which seems like ages ago at this point. One of his big passions has been coaching his 3 kids' baseball, soccer, and basketball teams, all while enjoying as much travel as humanly possible with his bride, Maria, and their family. During today's event, Greg and I are going to get into the intricacies of 1031 exchanges, and the DST, or Delaware Statutory Trust, is the acronym, covering both basic principles, some advanced strategies. So whether you're a seasoned investor or if you're just starting out, there's going to be something for everybody today. It's going to be a pretty comprehensive, fun discussion. So again, any questions, prepare them, throw it in the Q&A chat. It'll stay confidential. We're not going to call out any names, but let's go ahead and dive in. Greg, I'm going to pass everything over to you here and let you share your screen.
All right. Thanks so much, Adam. Greatly appreciate it. Like Adam said, and to answer that question, it's been many, many thousands of exchanges, but I have no idea. I've never added them all up. All right. Looks like my screen is coming through there now. So
Good.
We're past the technical test as we get started here. But yeah, so I am with a company called Investment Property Exchange Services, Inc. We go by IPX, keep that a little more simple. We're the country's largest qualified intermediary for doing 1031 exchanges, and this is all that we do. So at its most basic level, what is a 1031 exchange? Well, the name comes from Section 1031 of the tax code, as you probably guessed, and it's been around for more than 100 years. So it started in 1921, and it's the idea that when you go to sell your investment real estate, if you'd rather not pay all those state and federal taxes that we'll talk about, and you'd rather be able to reinvest 100% of your money into more real estate instead, the IRS allows you to do that. So it's a great tax break that applies to real estate, that doesn't apply to other assets. And let's just dive into it here. All right, so there are so many taxes. So it's not the simple 15% that so many people think it is. They've heard, hey, the long-term federal capital gain tax is 15%, so that's all it's going to be. Well, it's never just 15%. All right, at the very least, you're going to add on state tax. We'll talk more about that in a second. But just that 15% tax goes up based on the Affordable Care Act tax, which adds 3.8%. There's an extra 5% from a law about 10 years ago when we were at a fiscal cliff and they needed to tax us more. And there's depreciation recapture tax. The depreciation recapture tax can be the biggest and the scariest tax of them all. All right, I'm going to see, I think, yeah, good. The next screen. So a lot of people don't understand this, especially if you're not a seasoned real estate investor, but depreciation is the idea that your property is crumbling away over time. So if you own commercial property, they put a 39-year lifespan on it. And if it's residential property, they say 27 and a half years. So theoretically, your property should be down to down to dust at that point. You've only got the land value after that amount of time. Now, we know that doesn't always work out that way. Thankfully, sometimes our properties go up in value. They don't crumble away. So when you go to sell your property, Uncle Sam is going to say, wait a minute, we've been giving you these amazing tax breaks. So let's say you went out and you bought a $5 million piece of real estate. The land value was considered $1 million. The improvements or the buildings were worth $4 million. If it's commercial property, you take that $4 million, you divide by 39. And if it's residential, you take the 4 million and divide it by 27.5. That's supposed to be the useful lifespan. So that's a huge tax break you get every year, and you can use that to offset income. So that's a great thing for real estate investors. However, like I was saying, you get to the end, you're ready to sell your property. Uncle Sam is going to swoop in and say, wait a minute, your property went up in value, or maybe even didn't go down in value as fast as it was supposed to. So we want our money back. They're going to take the total of all the credits you received through the years. On some properties, this could be hundreds of thousands or millions of dollars of credits, and they're going to tax you 25% on it. So that can be the worst tax in a lot of real estate deals. And you've got those the state taxes to go along with the federal taxes. In Ohio, it's not the end of the world at 3.5%, but when you're selling out there in California and repositioning to Ohio, guess what? Out on the crazy left coast, they want 13.3% as a state tax. So all of a sudden, a person who was thinking 15% has a massive 25% depreciation recapture tax to pay. They've got possibly a 23.8% long-term federal capital gain tax to pay, and they have some kind of estate tax to pay in a lot of states. As you'll see, there are also those states like Texas and Nevada and Wyoming and a few others that have a 0%, like Florida and Tennessee as well. So it's all over the board. But the bottom line is never think it's just 15%. It's more likely to be close to double that. So taxes are brutal. The obvious advantage of a 1031, you can defer all of those, reinvest 100% of your money. Now, these are called like-kind exchanges, and that confuses a lot of people. And many people come in and say, well, I'm selling a duplex, Greg. I know I've got to go out and buy a duplex. And that is not the case. This was a much more complicated subject prior to the Tax Cuts and Jobs Act in 2018. Prior to that, our company was handling exchanges of just about everything you can think of that could have a capital gain tax applied to it. The only notable exceptions are stocks, bonds, and notes. Those were never 1031 eligible, but everything else was. So you could have business equipment, you could have aircraft, you could have fun things like artwork, racehorses, collectibles, and you were allowed to exchange rather than pay the taxes as you sold those things. When it came to those items, if you sold an aircraft, you had to go out and buy an aircraft. You sold a particular type of business equipment, you had to buy either the exact same type or something pretty close within the categories of that business equipment. But real estate has always been incredibly flexible. It's any kind of business use or investment real estate can be exchanged for any type of business use or investment real estate. So it's perfectly okay to sell your duplex and buy a commercial office building. Or you could sell a commercial property and buy a shopping center. You could sell a condo and go buy a Delaware Statutory Trust, a securitized property. We'll talk about those for a few minutes later. So it's very flexible. And it's, again, any kind of business or investment real estate can be exchanged for any kind of business or investment real estate. The numbers about how this works to get full tax deferral, this definitely confuses people quite a bit as well, and I understand why. There are other sections of the tax code that do things differently. So if you're used to a different section, these rules might be foreign to you. But the basic idea here is the IRS wants to say, hey, if nothing changes, sure, you've gone out and acquired property B after you sold property A, but if the numbers are the same or have gone up, we're going to say, great, no taxes are due. Now, this is very different than the math problem when you're doing your taxes if you want to not do an exchange and pay the taxes. In those cases, you're going to look at, hey, how much did I pay for that property originally? And, oh, I paid $100,000 for it. And then I maybe put a new roof on it for $10,000. That's going to up my tax basis to $110,000. I took so much in depreciation credits through the years, so that'll be factored in. And then you're comparing that with your net sales price. So your sales price minus costs such as real estate commissions and title fees. And that's going to tell you how much appreciation you have. And then they're going to tax you, like we said, on those tax rates on the appreciation, tax you 25% on the depreciation. And that's one equation. But when you're doing the exchange, now you no longer care. It doesn't matter to the IRS what you paid for the property or how much you did in improvements. Those aren't the numbers that matter. Instead, they're going to look at your net sales price and see if you're matching that up. So specifically, they're looking at two things. Did you keep any cash from the sale? Did you keep any of the proceeds? And you can, it's okay to do that. You say, hey, I want to keep $10,000. Well, you'll pay your taxes on the $10,000. But if you want to get 100% tax deferral, don't keep any of the money. All the proceeds from the sale go to a company like ours, qualified intermediary. We're required to hold that money until we use it to buy your replacement property. So the second part of it, besides not keeping the cash, is replacing any debt paid off. So that won't always apply. Sometimes your properties are free and clear, but assuming you've got any debt on it that you're going to pay to the bank on your closing statement, if you paid $212,000 to Bank of America, then the IRS wants you to match that up. So you can either get a new loan of $212,000 or more, on the replacement property, or you could add additional cash from outside of the exchange. So if you didn't want to get a new loan, you could always come up with extra cash from your other account, buy the new property with all cash, and if you buy it for equal to what your old property was, the net sales price, again, no taxes are due. You'll see number 4 on your screen there, receive nothing in exchange but like-kind property. That doesn't come up too often. Let's say you sold a piece of farm ground in Ohio. We've got a lot of farming in Ohio. Sell a farm for $1 million. You go out, you buy a hotel for $1 million. At first blush, that looks like a perfect exchange, $1 million for $1 million. But upon further review, you were buying a working hotel. And that hotel has kitchen equipment and furniture throughout it. Lots of things in there that are not considered real estate in the tax code. So what that means is maybe you sold $1 million of farmland that was real estate, and you only bought $700,000 of real estate on the hotel, and $300,000 was what we would consider personal property or anything that's not real estate. And that means you're going to have a tax hit unless you go out and buy another $300,000 of real estate. So that comes up rarely, but you do want to know about it. Okay, a couple quick examples here so you see the numbers. Okay, we're going to say in each of these cases, you're starting out by you've sold a property for $1 million. You paid off $300,000 of debt. $60,000 were your costs of sale, things like real estate commissions, title fees. So you would have been paid $640,000 at closing, but instead you have that money sent from the title company directly to your qualified intermediary. I should really stress, the moment you even have a right to receive the money or you touch or control that money in any way, it becomes a taxable sale. So you set up your 1031 exchange before that sale goes through. So the qualified intermediary then has the right to receive the funds. All right, in the first example, you find a property you want for $1.3 million. You've gone up in value. So you get a larger loan. You use all the proceeds that were available, $640,000 as your down payment. So you've got nothing as far as mortgage boot and nothing as far as cash boot. This is a perfect exchange. You owe no taxes. It makes sense. You bought a more expensive property and you didn't keep any of the cash. Second and final quick example here. This time you bought a less expensive property, $800,000. So you've gone down in value, obviously, by $200,000. Your loan is a little smaller. You paid off $300,000 at the time of your sale. The new loan, $260,000. And of the $640,000 that our company was holding, you only need us to wire $540,000 in for the closing. $100,000 goes back to you. That's going to end up being taxable boot. And the $40,000 you were relieved of in debt, that's going to become taxable boot. So you went down in value by $200,000, but you have $140,000 of boot because of the $60,000 of costs. So they're not going to tax you extra considering you paid real estate commissions, title fees, and so on. So that's how the numbers work. Now this gets a little more complicated. The IRS wants to see you buying property held primarily for investment or use in a business. They don't want you necessarily buying property that they considered primarily held for resale. So it's obvious if you're a big home builder and you go out and buy land, you divide it up into lots, you go and sell off new homes, they don't want to give those people a tax-free business. Okay, as they sell each home, they're selling their inventory of their business. They get taxed at ordinary, corporate income rates or standard individual rates, but they're not going to get taxed at the capital gain rates. So you do get into gray areas. Sometimes maybe you buy a property, your intent 100% is to fix it up and flip it. You want to get that thing sold within 3 months if you can. Well, the IRS would say that's not 1031 eligible because, again, that's primarily held for resale, not held for investment. But what if you bought it and you think, I'm probably going to fix it up and hold it for the next 10 years as a rental, but maybe I'm going to sell it. Or you think, I'm definitely holding it for the next 10 years as a rental, but someone comes along six months later and gives you a ridiculous offer and you just feel you have to sell. Well, in those cases, you can probably do a 1031 exchange, because it's all about your intent. So that makes it a little strange here. The IRS doesn't say some rule that's simple as you have to own the property a year or own it 2 years or any length of time. Instead, they say you have to have the proper intent, that your intent was to hold it for investment, as opposed to, again, holding it primarily for resale. We're going to talk about a few of these other issues later. I'm going to keep it moving. All right, now the next big thing is most exchanges, we call delayed exchanges, you have a 180-day time period, start to finish. So from the date you close on the sale of your old property, the IRS only gives you 45 days to identify what you're going to buy. Now, some people know what they're going to buy even before they know what they're going to sell, and they have it lined up so they close 2 p.m. on their sale and 3 p.m. on their purchase with the title company. But other people don't. They sell and they're out there looking for their new property. So by day 45, they're going to have to send us a form. They're going to have to say, here are the properties I might consider buying. And then they'll have another 135 days after day 45 to actually get closed on one or more of those properties they're considering. Okay. This is a no mercy rule. This is statutory law. Don't try to get around it. It's not worth it. Follow the rules. It's straight calendar days. You don't get extra time for weekends, holidays, or anything else you come up with. You do want to be on top of this. Now, there are 2 and only 2 ways to get this extended, and you don't really want either one to happen. Okay? The first is a federally declared emergency. Those happen more often than you would think. So federally declared emergencies are most often, what am I looking for? Weather disasters, hurricanes and forest fires and all these types of things that might affect you, flooding. So when those things happen and affect your property or you're closing in some way, the IRS will come out with specific guidance and tell you exactly how much extra time you have. And the other one that thankfully doesn't happen too often, but if you get sent overseas to fight in a war on behalf of Uncle Sam, yes, he'll give you extra time for your 1031 exchange, but that's it. Now, there's something called a mini deferral I'll mention quickly here. The mini deferral is, let's say you close on December 1st and you're a standard taxpayer, your tax year ends December 31st, your 45 days starts, you don't find the property you want to buy, so after 45 days, QI gives your money back. Well, you're getting the money back in the next tax year. This same thing can be used if you close on September 1st, you do identify property, so you go the 180-day length, that takes you to the next tax year, you get your money back the following year from the QI. You now have the choice. You can either pay your taxes for the previous year when the actual sale went through, or you can tell the IRS, hey, we sold last year, but didn't get our money till this year. So you report it as an installment sale and can put off your tax bill another year. So something to keep in the back of your mind. Even a failed exchange can have some nice benefits. Now, I mentioned you have to identify what you might buy within 45 days after the date of your sale. They came up with some very strange rules for how you do that. Okay, the first is called the 3 property rule. That one's simple enough most of the time. And that means you can identify any 3 properties at any value. And if you name 3 or fewer, you're good. However, some people want to name 4 or more. That could be for 2 reasons. One could be they actually want to buy 4 or more properties. And sometimes it's because they just want to have more options. So they might not actually buy 4 or more, but they want to name 8 and buy 3 of those, right? Well, they limit what you can do there. It's called the 200% rule. Anytime you're naming 4 or more properties, you'd look at the fair market value of what you sold. So if you sold property worth $1 million, your 200% limit becomes $2 million. So now you can go out and you could name 20 $100,000 properties, maybe go out and buy half of those and defer all your taxes. And that's going to work because you're under that 200% limit, but you can't name a 21st property. It's going to take you over the limit. Now, obviously you're past the 3 property rule. You're also past the 200% rule. Then there's this thing called the 95% exception. You don't want to rely on that. I'm just going to mention it quickly. But if you do name more than 3 properties and you do go past the 200% limit, you'll still have a valid exchange only if you acquire at least 95% of the total value on your list. Don't rely on that. That's too dicey. All right. I get the call several times a week from people who want to sell their property, say in Columbus, Ohio, and they want to buy a beautiful property on Put-in Bay, Lake Erie, or Hilton Head, or Florida, Arizona, what have you. It could even be down the street, but what they really want to do is make it a personal vacation home. They don't want to rent it out. They don't want to treat it as investment property. So you give them the bad news initially that that would not qualify. And they say, well, how do I make this qualify? And the IRS did give some guidance. And the guidance in my mind is very favorable. All right. Here's what it says. For the next 2 years after you acquire that, we'll call it a Hilton Head property, you've got to rent it out at least 14 days per year in those first 2 years. The same thing goes, the same 14 days applies, however, to your personal use. They don't want you to use it personally more than 14 days in a year, unless you rent it out a lot, and then you can use the 10%. So let's say you rented your property 300 days, 10% of that would be 30, so you get 30 days of personal use. So if the 10% gives you more than 14, great. But if you can live with these safe harbor guidelines, the IRS can never challenge your exchange. And once you get to year 3, you can do anything you want with the property from that point on. So if you want to make it a pure family vacation home, never rent it out again, that's great. They'll say you use this investment long enough, you're 1031 qualified, you can move on. You could even move into it at some point, make it a principal residence, and start taking advantage of some benefits under Section 121. So some great options there. We like to use the term swap till you drop. That's what a lot of people want to do with 1031 exchanges. So anytime they sell property, they do a 1031, they reinvest, they never pay any state or federal taxes along the way. And then eventually, hey, it's gonna be your time someday. When you pass on, it's a beautiful thing tax-wise, all right? Your estate won't pay any taxes, your heirs won't pay any taxes. Your favorite daughter gets the property at what's called a stepped up tax basis. That means if the property is worth $850,000 when you pass, she gets it as if she just bought it for $850,000. And if she turns around and sells that property, it's going to be completely tax-free to her. So that is a beautiful thing. Now, there's other types of exchanges than what we've been focusing on, because the delayed exchange with the 45 and 180 days, that's 90% of exchanges that go on. There's something called a simultaneous exchange. And if you and your neighbor want to swap properties, you can even do that if no money's changing hands without a qualified intermediary. So if you're just deeding property back and forth with no money, that's a very simple type of exchange. You still have to report it as a 1031 exchange. You'll do a form 8824 with your tax return, but that's it. You don't have to use a QI. Now, the reverse exchange, that's when you want to buy your new property before you're able to sell your old property. Sometimes these are planned. In fact, we've seen more reverses than ever the last few years, because some people know they can sell their property quickly, but they don't want to be in that 45-day period where all of a sudden they're hustling to find what they want to buy. So they go ahead and sell first. They go ahead and buy first. And what's strange about these, the IRS does not especially make these easy. They say you can't own the old and the new at the same time. So if you want to buy the new property first, our company is going to set up a new LLC. We're going to go into title on your new property on your behalf. You and or your lender are still paying for it. You'll have full control over the property from day one, but we have to go into bare legal title to keep the IRS happy. From that closing date, you've got 45 days to identify what you're going to sell. That's usually very easy. And you've got 180 days to get it sold. In recent years, that's been pretty easy for most people. Of course, during the Great Recession, harder times, sometimes people couldn't get their property sold within 180 days. So that's the reverse exchange. The build to suit, also called a construction exchange or an improvement exchange, that's when you want to add value to your new property. So you might be buying land and you want to build, or you might be buying something existing and you want to put a lot of rehab into it. The IRS, similar to a reverse exchange, is going to make our company take title to that property. You only have the rest of the 180-day period to make improvements, and whatever you can get done during that time is what can count towards your tax numbers. The reverse build to suit adds the last two together. You're going to buy first and do construction. So these can all be done. They're more complicated. They're more expensive. They take more planning. To give you an idea on expense, when you're doing a standard exchange, our company charges $1,000 to set up the exchange and handle the sale, and $250 for the replacement property purchase. So 90% of exchanges have a total fee of $1,250 when all is said and done. That's usually a relatively modest cost in the real estate process. With reverse and construction exchanges, it can be a little bit more important. They start at about $6,000 and go up from there, depending on the value of property we have to go into title on, whether construction's being done, whether a lender's involved, and a few other factors. So most reverse and construction are in the range of about $6,000 to $10,000 in fees. So that's something good to know about. A combo exchange is really just using a reverse and a delayed exchange together with one property in common. So let's say you want to sell 10 rentals you have for $100,000 each and go buy $1 million apartment building. You can use both in such a way that you might sell 6, buy the new apartment building, then start a reverse exchange to get another 180 days to sell the other 4. So that's just a quick explanation of the combo exchange. It's using 2 types of exchanges with at least one property in common. All right, the DST. Let's spend a few minutes on this before we run out of time here. So the Delaware Statutory Trust, this is something that's not sold through real estate agents and brokers. These are sold through financial planners as securities. So a company like Inland out of Chicago, they happen to be the largest player in the DST market. There's lots of other great companies, Next Point and Cantor Fitzgerald and Blue Rock and more. Inland happens to be the biggest, so I just mentioned them as the example. So they'll go out and they might buy different varieties of property, right? They're going to buy college housing, and they'll buy college housing at USC in Texas and Florida. They'll bundle those together into an investment. Maybe they paid $50 million for the property. They went out and put a $25 million loan on it. And then you come out of your rental property sale, and maybe you sold a property for $600,000 and had $300,000 of cash and $300,000 of debt paid off. And that you come into this and you say, wow, those numbers are perfect. I'm going to invest my $300,000. There's already debt in place. I get a $600,000 piece of this college housing. Inland's going to tell you, all right, our plan with this one is to hold it for, say, 7 years. During that 7 years, you're going to get, say, a 6% cash on cash return. Your share of the rent payments paid to you every 30 days. And then at the end, you hope it does well and sells at a high price, and you also get back end appreciation. So that's the most general idea behind a DST. So there are all types of properties. Again, it could be multifamily apartment complexes. It could be medical office space. You know, it could be just about anything, but they'll typically keep it together. So it's not going to be college housing mixed with multifamily, mixed with, an office building, medical office. It's one asset class is typically what these providers do. And you can look at their investments that are out there and see if that's something up your alley. So again, you're going to talk to your financial planner, not to a real estate broker about those deals. All right, let's skip through these real quick. Just take about 1 more minute here. Mention the qualified intermediary. So I've been talking about that's what we do. Again, one of our main functions, we have to hold the proceeds. We're also going to do the legal documentation, such as the exchange agreement, the assignment of contract, other documents such as the identification form needed for the process. And we're going to work with the title companies on each side. That we're going to have them send us contracts and commitments. which we review before we draft up those documents. And we're going to help you through the exchange process from start to finish. Afterwards, we're going to send you a tax form. We call it the final account statement. It gives you the facts and figures you need to hand to your accountant so that your accountant can do that Form 8824 with your next tax return to show that you've completed your exchange. So that's the basic idea. As Adam mentioned, I've been doing this with IPX for 22 years now. So we're certainly happy to answer any questions you might ever have. We never charge anything for consultations. Always feel free to reach out, email, call, what have you, and we're happy to walk you through what works and doesn't work. And there's never any charge unless you end up wanting to do the exchange. So I think at that point, I've been talking for a little over 30 minutes, and I want to keep us on schedule. So I don't know, Adam, did you want to jump in, and do you have any final comments here?
Yeah, sure. And by the way, you already hit the nail on the head, but this is what you do all day, every day. I already mentioned that, Greg's done, I mean, hundreds of these presentations, I'm sure at this point. 1031s, is it safe to say thousands? I mean,
Many thousands.
awesome.
Yep. Oh, I'm sorry. Of the presentations, yeah, I don't know. Certainly many hundreds.
Well, and then the cost of doing this, being the intermediary, getting it done right legally, not running into those, roadblocks. I think oftentimes when you get into real estate, some people who are real estate investors are very proud to do things on their own. They're very proud for being, whether that be they're handy or they're just intelligent people. And I think when you start trying to do a 1031 on your own, it probably pays to fork over the tiny cost to make it legal and seamless, if that makes sense. So what I'm going to talk about just for a couple slides here is I'm going to maybe do a tad bit of duplicating efforts in terms of the DST. I want to kind of step back to a 30,000-foot view and talk a little bit about the basics for the people out there that don't really understand this stuff at all. Maybe they own one or two or three investment properties in their place that they live, or maybe they're a business owner and they own the building that they rent. They rent to themselves, or they own a few commercial buildings perhaps. So for any real estate investor, whether it's your house, whether it's an investment property, all of this applies. Vacation homes and so on, as we talked about earlier. So the first thing I want to chat about is that you've got, different types of investors. And the way I like to split it up in order to make it simple and understandable is you've got active investors and passive investors. When you got active investors, that would be your residential property. So I own one property, two properties, three properties, 10 rental properties. Maybe it's single family, maybe it's multifamily. You might even have an apartment complex, a duplex, things like that. The second type of active investor would be somebody who owns commercial property, and it's similar. Like we own our office upstairs, and we have a tenant that rents from us, and then we rent from ourselves. A separate company owns the commercial property, but it's not tied in with Libertas in this case. And then there's another type of active investor, which is something called a qualified opportunity zone. These are, I don't want to call it new, but they're relatively new. Somebody that we work very closely with with Elevate is an attorney named Andrew Daup. He owns syndicatedcounsel.com. If you'd like to check out Syndicated Counsel, you'd like to learn a little bit about opportunity zones and how to defer taxes on real estate capital gains, then he and I have done podcasts together. I think we might have done a webinar together, but we've done podcasts together, and that's really, really interesting stuff, again, because it is relatively new. And then we have passive investors. And when I say passive, I mean that you don't physically own the real estate. You don't necessarily. I was going to say you can't walk up and touch it. Technically, you can walk up and touch it, but it might not be in the city you live, for instance. So an example would be owning traded real estate investment trusts. Like Duke Realty. You can just go on the New York Stock Exchange, or to Charles Schwab or Fidelity. You can put the symbol in and hit buy 100 shares, and you own it. So that's traded REITs. Then you have private non-traded REITs, which I don't do a lot with unless they're DSTs, but I'll get into that in a second. So private non-traded REITs are owning real estate, but owning it off market. It's not traded on the New York Stock Exchange, the Amex, or what have you. So this would be owning private real estate. You're not as much in control of the properties when it's liquidated and so on. And There have been some wonderful REITs in the past, and there's also been some not so great REITs in the past that haven't done so well and have been really disappointing. So the biggest issue I have with these though is the liquidity or lack thereof. So similarly speaking, we have business development companies or BDCs for short. Business development companies are very similar to non-traded REITs, except instead of owning real estate or equity, you own the debt. So you're basically a part owner of the debt that's being lent to other organizations for the purchase of, let's just say, real estate. Then there's QOZs, so qualified opportunity zones that you can own passively through non-traded REITs. And then last but not least, where we're going to focus all of our time on here, or the remaining time, is on, again, as Greg mentioned, Delaware Statutory Trusts or DSTs, because this is where the secret sauce is. This is what I get really, really excited about. If we look at how to avoid cap gains on real estate it's a complement to most retirement portfolios. If you own it until you pass away, so if you have one property or 10 properties, it doesn't make a difference whether it's commercial or residential. If you own it until you pass away, then at passing, it steps up in basis. So therefore, your heirs, your beneficiaries, would not pay tax on the gains. But if you sell it while you're living, there's typically large capital gains tax that exists. And as we learned today, it's not just your 15%, right, Greg? So a whole lot more than just 15% is typically paid on real estate, and it all depends on what state you live in and so on. So at some point in your life, these are the two scenarios, or the two most common scenarios that I see. There are certain scenarios where investors just get tired of owning the real estate. Maybe whether they're retired or not, but especially if they're retired, even if they have a property management firm that's helping them to manage all the properties and take care of them and fix them and mow the lawns and all that, there still is a certain sense of the toilets, tenants, and trash, whether that's they call it the three T's, the terrible T's, whatever you want to call it. So the scenario number one is where an investor is typically getting close to retirement or they're retired and they just still don't feel like they're retired yet. In other words, they don't feel like they can, go on a long vacation without being interrupted by the real estate that they own. It was a great investment for all these years. They've seen, significant appreciation in their properties. They've received wonderful, supplemental income to their Social Security if they have a pension and so on. So they've got this, cash flow coming in from their real estate. The properties may be paid off partially or fully paid off. So it's really, there's a lot of barriers to exit, I'll call it, which what I'm saying is that it's hard to want to get rid of them because, we've got cash flow coming in. We've got an appreciation in the asset. If we sell them, we're going to have to pay cap gains tax, and more than just 15% again, as we discussed. So, but still, it just gets too annoying. It just gets to a point where I'm just tired of it and I want to get rid of them, but I don't want to pay the tax. So people just don't do it. They just don't sell it. They just wait and they hold them. The second scenario is somebody who maybe doesn't really care so much about the hassles, however small they might be, of owning a real estate portfolio, whether rental properties and so on, commercial, residential. But as they're getting older, they start realizing when they have serious conversations with their family and they're talking to their attorney, their estate planning attorney, about end of life planning and things of that nature. Not that they're going to die anytime soon. It could be, it could be 60 years old, 65 years old. You don't have to be older, even though when you're 80 or 85, you're probably thinking about this a little bit more. But point being, when they're gone, their kids aren't going to want to deal with the real estate. Maybe they don't know how to deal with it. Maybe it's too much of a hassle for them. Maybe it's not their passion. Maybe there would be a lot better way to inherit this money than to inherit a portfolio of rental properties, which, to the kids might feel more like work, even though the benefits are awesome. It just might be too much of a hassle for them. And so this is where we start looking at this strategy using DSTs and 1031 exchanges to avoid the capital gains tax on that real estate. So what we do is we take like-kind property, which is passive property. Remember, we talked about active and passive earlier. You can still 1031 into another property. You can still be an active real estate investor, but that's not going to solve the problems of the annoyance, the three T's, and and the kids who don't want to manage the real estate when you're gone. So passive real estate that produces income, but without any management whatsoever, is the solution. And when you do a 1031 into an income producing passive non-traded DST and a non-traded REIT, what you end up getting is, first of all, you avoid the capital gains tax, and then you can defer it literally forever until you pass. I shouldn't say forever, but until you pass. So you find another like-kind property to invest in with the help of a professional realtor, with the help of someone like myself, another independent fiduciary financial advisory firm. They have access to lots of companies. And Greg, I'm glad you mentioned inland, because the examples I'm showing today are actually inland properties. So they're older, so they probably don't exist now at this point, but it's still just as examples. I used inland as well because they are the biggest in the country, if not the world. So we find the property. We can purchase one or several properties. The larger your investment portfolio or your real estate portfolio, the higher the probability that you might want to 1031 into more than one property. If it's just a small profit or a small, single property, you're probably fine just doing one DST and one 1031. But if you have several and the lump sum is large, then you're probably going to want to do, diversify it into several different sectors. And as you can see on the right there on our screen, as Greg was mentioning, there's lots of different sectors we can get into, and there's no shortage of options, truly. So hospitality, multifamily housing, retail, student housing, which is getting really big. Healthcare isn't going anywhere as the baby boomers get older. Self-storage has been huge recently. Industrial, think Amazon, things like that. Office buildings, especially medical office. So we can 1031 into one of these, into a passive property, we can avoid the terrible T's by using a Delaware Statutory Trust in 1031. And again, it qualifies for step up in cost basis, which is the other piece of the secret sauce. So the first secret is we can 1031 into a passive portfolio that you do not have to manage, and your kids don't have to manage, while still receiving income, cash flow, like the cash flow you were receiving when you own the properties, except you're not managing the real estate anymore, and you're not dealing with a property management company anymore. And again, the kids aren't going to have to deal with it when you're gone. And then second of all, when you are gone, it qualifies for the step up in basis. So when you pass, all of this steps up in basis and it transfers to the kids in a very, very efficient manner, unlike physical real estate, which would be quite a hassle to transfer to the next generation and to have them taking care of the sale of these properties if they want to sell them. So I'm going to skip over all this, Greg, because you already went over it. I just wanted to share a couple case studies here. The first being a statistic or a table here that shows when you look at high net worth individuals, there are a lot of people who own real estate. So 25% is kind of the sweet spot there, where the Gaussian bell curve, if you will. So roughly 25 to 35% of the average high net worth individuals' investment holdings are in real estate of some sort. And then when we talk about these DSTs specifically, I'm just going to share three examples. These are old examples, so they're not available any longer, I don't believe. But it still gives you a really good idea of the kind of stuff we'd be talking about. So here's the first one, to Chicago Healthcare. It's basically a healthcare system. The minimum investment for this was $100,000. So if you had a property and you sold it, you'd need to have at least $100,000. And you can see the total availability. And at the bottom there, the thing that probably everybody wants to know is how much am I going to get? And in this case, it's 3.5% would be the cash on cash return for this property. The second one, as an example, is a place called Lakewood Ranch. This is single family housing. Think like worry-free living, retirement housing, people that are downsizing. Again, the minimum is $100,000. The total availability was 61 million at the time. And then again, you can see the cash on cash return there would be 3.15%. And then last but not least, the last example here is a student housing portfolio. So this is, think dorms, student housing on or off campus at universities around the country, colleges around the country. And again, minimum investment 100K on the 1031 and a cash on cash return at 3.25%. So essentially, to close out here, by using 1031 exchanges to sell your commercial or residential real estate properties or portfolio, what you're doing is you're able to avoid the capital gains tax right now by investing in a separate non-traded property. The second thing you're doing is you're avoiding the work and effort that goes into managing the properties and or the management company. The third thing that's happening is, let's just say one of these portfolios sells. Well, if it sells and you take the cash, you'd have to pay the tax, but you can then 1031 into another DST. So you can keep doing this every time one liquidates, because chances are these are going to liquidate at some point. The average is usually 7 years. So every 7 years or so, give or take, call it 3 years, you're probably going to have to 1031 and move it to another property when it's sold. You will get not only the cash on cash return over time, so think of it like getting your rent, so to speak. So you're going to get your rent at this one we're looking at on the screen here. The student housing portfolio is 3.25%. And then when it's done, if assuming it appreciated in value, we also get the appreciation in value when sold. And then we would 1031 it into another DST that we choose together. So it does all of those things. And then when you are gone, heaven forbid something happens to you, but eventually we all die, right? But when you're gone, all of this money that you've spent over the years investing in this property, benefiting from it, both on an active and now here in this case, passive rate, now passes on to your kids, your family, to completely tax-free and steps up in basis upon your passing. So really, 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 really cool stuff. And that's where I'm going to end. So I'm looking over here at my screen. It looks like we have, and I'm going to defer these to you, Greg. It looks like we just have two questions. The first one is, what kind of deals are you typically seeing these days when it comes to exchanges, especially considering the fact that interest rates, there we go, interest rates are so much higher now than they were, say, 2 or 3 years ago?
Sure. Well, the first thing is during during COVID, things just went crazy in real estate, as everyone knows. So in 2020, after like 1 week, that was a blip while the world freaked out. Then real estate started going nuts. We just started having record-breaking years, 2020, 2021, 2022. And then things have started to even out a little bit since the end of 22. So 23, 24 now. The thing is, all I hear from people, real estate agents, title companies, and so on, is that things have slowed down quite a bit. But it's slowed down quite a bit from what was pure insanity. And it's actually still really, really busy. So we're still having our best years ever. There's still a ton of activity and huge numbers of exchanges that people are still completing. So it hasn't, the interest rates, to answer your question, they've absolutely slowed down certain sectors a little bit, but overall volume is really, really historically high still, and a lot of exchanges are taking place. And, I'm 53 years old, and when I started, people would cry tears of joy if they could get something like a 7% or 8% interest rate. So historically, we've seen much, much worse through times. 10, 20 years before I started, interest rates could be 20%. People still did deals. So it's just this craziness of people seeing 2 and 3% interest rates that now people think these interest rates are astronomical, when historically they're still pretty good. So there's still an evening out of the market. Of course, we may see some rate cuts this year. Things may start to go down again a little bit more. I'd almost be shocked if in my lifetime we ever see 2% rates on anything again, but you never know. So I guess what types of deals are being done? It's still almost everything. Everything is still moving. Multifamily is still super hot. College housing hot. Storage hot. A lot of that stuff is really moving. Like you would expect. Some retail, shopping malls, offices. Those, depending on where they are, they can be great or they can be pretty questionable. They're not everyone's going back to the office still and may never go back. So I think we're all getting used to that. So certain types are certainly less hot. And but yeah, I mean it's still moving. We're still seeing people getting deals done. So I hope
With
that answers the
the
question.
office, in the office sector specifically, because you've got, for those that don't know, you've got, let's just say C-class office space, which is like the, bottom of the rung, not so nice strip malls. Then you've got your B class, which is kind of, smaller office buildings, nice-ish. Typically, you'll see like, 1 or 2 story buildings. They're nicer, but they're not, it's not A class. Then you get into A class, which would be your really nice buildings. Think, 3, 4, 5, 6 story glass buildings that look nice. And then your trophy space, which is your skyscrapers. When you look at the market right now, I'm curious what you think is struggling now of those office space sectors? And what do you project going forward when leases start to expire? Do you have any thoughts on which sectors might struggle the most versus maybe kind of weather the storm?
Yeah, it's a great question. I mean, seeing it from the QI aspect, we don't always know. We don't always, see those details. And, my first admission is your guess is probably as good as mine. But if you're going to make me guess between A, B, and C, uh, I think the most primo A still is going to do fine. There's going to be demand. The lesser A might struggle. And then the C can be great buys. So people are going to buy that, fix it up, and at least try to raise it up to the B level. So I'd almost say lower A and B would be where the most risk is. But again, that's just a stereotype and a generality.
Yeah, I agree with you. I think some of the biggest struggles are going to be in office buildings that are non-medical and non-service based. What they would say, during COVID, they said essential companies. So we'll say non-essential companies that don't need an office. It kind of maybe I'm stating the obvious here, but anyway, that was just my question. I was just thinking about it as you answered the
Yeah,
first.
no, that makes sense.
The other question that we have here is, I've heard that. Let's see here. I've heard that these 1031 rules are going to go away. What's the best way to stay on top of changes in tax law and government policy should anything change down the road?
Yeah, so I understand why people think that, and I've been getting those comments for 22 years from the very beginning. There's always been something. The biggest change came actually during the Trump administration that I mentioned, with the change where they went to this immediate expensing instead of 1031 for all the assets that weren't real estate. So that was really the biggest shakeup. Luckily, that hasn't hurt our company or industry at this point because real estate's been really hot. When we get down to the bottom of a real estate cycle, that used to be when I would spend more time calling up businesses and saying, hey, when you sell your $1 million printing press and go buy the $2 million new one, your old one's completely depreciated. You're going to pay a massive tax there. Let's do a 1031 exchange. Well, all those things are out the door now. I can't do the aircraft exchanges that I was doing and collectibles and artwork and all that. So it's going to hurt down the road. But that's been really the only major change to 1031 in my time period. And every year, the Biden administration puts it into their budget that they're going to hack down 1031 in some way. They're allegedly going to bring in all this tax revenue, but they never do it. They never do it for two reasons. One, it's completely false. The government actually brings in way, way more money by having 1031 exchanges than by getting rid of them. And it doesn't seem logical at first, but the reason is that sellers are willing to sell their property if they're not going to get hammered by the taxes. And when the real estate's changing hands, everybody gets paid a lot of money. It's real estate agents making money. It's title companies, lawyers, accountants, so on and so forth. Everyone in the industry pays more in income taxes, and it brings in more money. And you don't have to take my word on it. Ernst & Young has done a major study twice, and a couple of college professors called Ling and Petrova out of Syracuse in Florida. They've also done a major study twice. They've done the macro and the microeconomic levels, and 100% they found it every single time. The government getting rid of 1031 would bring in a lot less tax money to the government. So as crazy as it sounds, that's the reality of it. So as much as they talk, knock on wood, you never know what stupid thing they might do anyway, but we get out there, we educate them, and they don't want to change it. And I was saying that's one of two things. The second thing very quickly is that members of Congress use 1031 exchanges. I've done half a dozen personally for members of Congress nationwide. We've handled a lot of them, and they don't want it to go anywhere. So don't expect any changes.
All right, mostly fear mongering then.
Yes,
All
definitely.
right. Well, Greg, this was awesome as always. I really wish that we could get this out there into the world and teach every single real estate investor, not to mention people who know real estate investors, about this trick so that everybody stays educated and knows what their options are and that they're not stuck if they're looking to make a change. So thank you for attending. If anybody'd like to get a hold of Greg, you can find him on LinkedIn. And next month, we have our next webinar next month is called The Art of the ESOP, Growth Strategies and Sales Secrets from Top Business Minds. We're going to talk all about selling your business and to an ESOP. In other words, selling it to your company, selling it to your staff. So join us for that insightful webinar. We're going to dive into the transformative power of employee stock ownership plans, or ESOPs for short. And then this webinar that we just did is going to be replayed. So we're going to have a recording that'll go on YouTube. So if you want to rewatch it, send it around to your friends, business associates, fellow business owners, and then we're also going to do a podcast here. So Greg and I are going to be doing a podcast as well that you'll find on the Elevate YouTube channel, as well as Apple Podcasts and Spotify. So head over to elevateandexit.com to sign up for invitations to future events. Subscribe on YouTube to get these replays sent to your inbox in the future as soon as they're published. We'd truly appreciate it if you'd fill out the survey that we'll be sending out. It'll be hitting your inbox today. We'd love to hear what you think, as well as any other ideas, concepts for future events. So, we want to hear your feedback. And then please follow Elevate on LinkedIn, Facebook, Instagram, and Twitter, or X as they call it now. And lastly, as I always say, owning a business is freedom, it's fulfilling, and it's unbelievably rewarding, but it's not easy. So why do it alone? Elevate doesn't exist without all of us, without you. So thank you so much for coming and joining us today, and we look forward to seeing you at our next event.